Welcome to Top of Mind, the show where we talk to real estate industry insiders and experts about the biggest trends impacting the market today. Enjoy the show.
Mike Simonson here. Welcome to the Top of Mind podcast. I'm Mike from Altos Research. Thanks for joining us. The Top of Mind podcast is where I talk to the smartest leaders, thinkers, and doers in the real estate industry to provide some context and perspectives beyond the market data that we put out every week at Altos Research. At Altos, we track every home for sale in the country, all the pricing, the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. People desperately need to know what's happening in the housing market right now, especially as fast as the landscape is changing right now. So if you're asking, where can I get the data for my local market? The answer is you can get it from Altos Research. Visit altosresearch.com, do a free consultation. We'll look at the data in your local market. We can talk about how you use market data in your business. So without further ado, though, I'm thrilled to introduce my guest today, Daren Blomquist. Daren is a widely recognized authority in housing and mortgage industries and is currently the vice president of market economics at auction.com, where he analyzes, forecasts, all the complex economic data trends to provide the unique insights on housing, often well before the headlines. And Daren and I have done some stuff on stage together, and auction.com has some a unique view on the world. So I'm looking forward to discussing that today. Prior to joining auction.com, Daren was the VP at Atom Data Solutions, where his research and reports were cited by thousands of media outlets nationwide. So he's somebody I've been very eager to catch up with for a while. So I'm super excited to have this conversation. Daren, welcome.
Thank you, Mike. Yeah, it's great to be here. I've wanted to catch up with you as well for a while.
Yeah.
and I enjoy seeing all the stuff that Altos Research puts out. And certainly it's some of the most real-time data I see, the first kind of data I see on the market before a lot of the headlines come out. So that is really cool and really good to be speaking with you today.
That's terrific. So let's start with you and auction.com for our listeners who don't know auction.com and you in particular. Why don't you give us an overview? What's auction.com doing?
Yeah, what we're doing is we're a online marketplace for foreclosure and bank-owned properties. So we're the largest distressed marketplace out there. And when I say marketplace, I mean marketplace. I think that word is kind of used loosely sometimes, but just to hit that point home, we actually are transacting on properties. We're the platform. We're not the seller or the buyer. We're the platform, and we facilitate as much of a transparent marketplace as we can, so the sellers and buyers are both happy with the outcomes and get the best price on both sides of the equation that they can. And so we're just to hit that point home, even in this market where foreclosure inventory is severely restricted or has been severely restricted and was already low before the pandemic, we're bringing to auction on the two sides of the equation, foreclosures and bank-owned properties or REO properties, about 4,500 properties a month this year.
Okay.
And so but if you compare that back to 2019, I was just looking at this to get my numbers right, but we were seeing about closer to almost 15,000 properties brought to auction a month. Now, one thing that's different in 2019. So, and 2019 was considered a low watermark, and it was a low watermark for foreclosure activity. So we've come down from there, but we are still we're transacting on I would say a pretty high volume of properties still, relative to at least anywhere else. And one of the really cool things that I get to look at is, we're seeing it's an auction platform. So there's bidding going on, and we're seeing that behavioral activity right in real time around a property, price realization happening in real time, basically. Within, at least at a foreclosure auction, that happens in a matter of minutes, that a property goes from being available for auction to being sold in most cases. And so that's happening very quickly, but we're capturing that bidding behavior. We're capturing the credit bid that the bank is setting the property at, how much they think it's worth, and how much they're willing to set that credit bid at. And so there's a lot of really cool information there that helps us see what is happening in the market. And I consider it the front lines of the market in many ways, because the people who are buying on our platform are investors, typically, who are buying the homes and either renovating them and reselling them as flips, or renovating them and holding them as rentals. But they're investors who are very, very hyper aware of the conditions in their market, typically, because they're selling back into that market.
Yeah. So tons there to get to. There's so much there I want to get to. The foreclosure inventory, where we are. I want to talk about that, where we are now and where we'll be in the future. Like, there's some real meat there. And I'm also interested in diving in more on what we're seeing right now with that bidding activity, in a world where the consumer buyer has backed way off. So lots to cover there. Before we get there, tell me about how you found your way to this role at auction.com, because you have a ton of data there and you present it very well. And so give me your background. How'd you get there? How'd you end up in our crazy little corner of the universe?
Yeah, I stumbled into this crazy corner of the universe probably about 20 years ago. I moved from Illinois to California because my wife is from California, and we met in Illinois, but we were like, let's go somewhere where we have family. So we came back to California. While I was looking for a real job, I got a temp job at this little company called Realty Track, which is a startup, and with maybe 5 to 10 people. And that was in 2001. About, very soon after I got there, we got placement on Yahoo, which was a big deal back then. And so we blew up. It was a subscription service. And Realty Track was a foreclosure listing service. Basically, this idea of you don't have to go down to the courthouse and get the information. We'll post it online for you. All this information about the properties that are up for foreclosure. And anyway, then we blew up after we got on Yahoo, basically, is a short and simple way to say it. And that company took off between 2002 and 2005. And then in 2005, we started putting out a report. And this was with a fellow friend of ours, Rick Sharga. He came on board at Realty Track, and we said, let's put out, how do we get some attention for our company? We have all this data around foreclosures. Let's put out a report. Started doing that in 2005. And all of a sudden the numbers in about 2006 started spiking, and we were reporting these amazing, sensational, some might call, percentage increases in foreclosure. And we got a lot of criticism that you're overstating the numbers, you're double counting the numbers. And all of a sudden, then in a couple of years later, people had to kind of admit, and we weren't doing everything right. We actually didn't even know all of what we were doing, but we actually did turn out to be, I think, right, that there was a problem brewing.
Yeah, for sure. You're one of the few people who've been at it in this space longer than I have these days. I started Altos in January 1 of 2006. So that's, it's been in there. And that was a real ride for Realty Track. That was a real rocket ship, right place at the right time for that company.
Yeah. What's interesting is that the company did well during the housing boom. We got a lot of attention during the downturn because we have all this data on foreclosures, but that actually helped us realize and evolve into a company that that sold data, became more of a B2B company as opposed to B2C, because we realized there's a lot of value for businesses in this data in a bulk format as opposed to just an online one-by-one property consumer format. And so that's the rest of the story is between maybe about 2009 and 2015, we transitioned into Atom Data Solutions, which is a company that licensed data and licensed the data in bulk, and not just the foreclosure data. It was all around the broader real estate data. But then in 2019, I came over to auction.com. I had been familiar with them for some time, and that just turned out to be a position that was tailor-made really for me, in my opinion. And so it came over here, and it's been a great ride. It's been a very interesting ride since then, of course, here with what's happened since 2019.
Sure. Okay, that's a terrific summary, and I appreciate that perspective. I moved from Illinois to California. Mine was about 98, 99. That's, as I say, two bubbles ago to move into Silicon Valley. Yeah. So okay. So you've been in the foreclosure data space for 20 years, watching the properties that get foreclosed, that have to get taken over by the bank or turned over and auctioned. And then during the pandemic, we had a foreclosure moratorium. Well, let's even start before that. 2019, as you point out, was already low, few numbers of homes in foreclosure. And primarily that's because mortgage rates were cheap and people had equity. Then the pandemic starts. We put in a foreclosure moratorium because a lot of people lost their jobs. And then the market took off. So even when people started working again, and even when the moratorium no longer exists, there's still very ultra few foreclosures happening. And so let's start with, so you said you guys are doing 4,500 a month transactions now. You were doing 15,000 a month in 2019. So a third of that level from 2019. 2019 was already low.
Yeah. And to clarify, those are properties brought to auction. Not all of those sell. But we're actually seeing a much higher percent. Right now, we're seeing close 50 to 60% of those selling. That sales rate is an indication of investor demand, which we can talk about. That actually has been just in the last few months. I think somewhat leading, or at least mirroring, the overall consumer. Those numbers have been coming down. But anyway, that just the 4,500 and 15,000 are the properties brought to auction, available, basically inventory. And then of those, 50 to 60% are selling, are actually selling. Yeah.
And so what else do we need? What else should we know about those 4,500 properties? I think it's interesting that they've obviously, we've had a ton of investor demand. And that you can imagine, I know some investors who are like taking a wait and see approach right now. So what are the characteristics of those homes, of that market, of those trends? What should we know about those 4,500 homes a month that are coming to auction?
Yeah, I think actually that's a great question, because it's not the inventory that we saw during the foreclosure crisis of 2008, 2009, where there's a lot of actually pretty new homes in pretty good condition that we're selling. These 4,500 are really the bottom of the barrel. I mean, for whatever reason, we get a lot of the questions like, why would anybody get foreclosed in this housing market with so much equity? But there are, unfortunately, there's situations where properties are in such poor condition, and in situations that are just the best option for the homeowner actually is to get out of there. And so that's what those 4,500 are. Those are the highly scratch and dent. I don't know if I like that term, but the highly distressed properties that need often substantial renovation, and that's why they're going to foreclosure. And they are, I mean, geographically, they're all over the country. We're nationwide, but we do see the most inventory still in the Northeast and Rust Belt, or kind of the highest inventory in terms of per capita, I guess you could say. And that's what those 4,500 are. There's a high percentage of slightly disproportionate percentage of FHA mortgages there. Tend to be a little bit more risky in this environment.
Right. So the FHA mortgages, they typically allow you to put 0 or 3% or something less down on the mortgage. And is that typically what makes them more risky?
Yes. Yeah. They're more risky because of the down payment, a combination of the low down payment, along with especially starting around 2014, FHA started loosening some of their requirements around debt to income ratios that started going up, and some other factors. But yeah, that makes them more risky. So they tend to be borrowers that are just a little bit more financially stretched, and so any kind of shock can unfortunately push them over the edge. Yeah.
Okay. So, and then if the house isn't well maintained, then you're like, I can't make the mortgage, and it's really hard to sell this thing because it's a bit of a wreck, or we haven't been there in a year or 2 years or something since the pandemic, and now we just don't want to deal with it anymore. And those types of things are what come into market. Are there signals in that data that's changing at all? This year we've got sort of wrenching economic changes, inflation. We've got some GDP slowdown. So, people still haven't really lost their jobs, but is there any signal that type of property is changing? So, for example, you said you're most commonly in the Northeast and Rust Belt is where we're finding those properties now. But
the average age, by the way, and there's a great study done by the Urban Institute that your listeners can maybe look up if they really want to deep dive into this. The Urban Institute looked at some of our data a few months ago, and one of the things they keyed in on is how old the properties are. I think the average age, depending on what cut of our properties you're looking at, it's around 1960 that they were built. Whereas the average age of, I believe you might know this better than I do, but the average age, I think, of all homes nationwide is around 1978. So, or the average year built. Anyway, so they're older properties that again leads into this more distressed piece. But to answer your question, we haven't seen a shift yet that I have noticed in the data away from that distressed, really classic distressed property, as opposed to just financially distressed, but maybe the condition isn't as distressed. Mm-hmm. We haven't seen that shift yet. I think, to your point, it starts for us, the biggest, our funnel to properties on our site starts with unemployment. And so that lever has not changed. Now, when that starts going up, that has a trickle down effect on distress. I mean, that's the number one driver of delinquency.
So that's, and the way I've been thinking about unemployment lately and the impact on housing is that, if you're unemployed for 90 days and starting to feel like I'm not going to find a job anytime soon, then you start really worrying about your money and you stop making mortgage payments. And then it's another 90 days of not making mortgage payments. before you even really trigger, like it's some real, like you start getting delinquency notices, but you're not in a foreclosure process yet. Is that correct? Is that a good way to think about it?
There's, I mean, right. And I am very loosely, I almost think of it like from unemployment to what, when it hits us, the first time we see it is when it's scheduled for foreclosure auction. That's going to be at least a year in most areas from that shock event to when it's scheduled for foreclosure auction. And that may be a minimum.
Yeah.
So, I mean, a lot of the properties we're dealing with, one of the reasons that the Northeast is still heavy inventory is they have some of the longest foreclosure processes in the country, processes.
Yep.
And we're actually still dealing with inventory that was created during the last housing bubble and bust there. Believe it or not,
like 10 years ago,
10 plus years ago. Yes. And so that's one of the kind of unintended consequences of those lengthy foreclosure processes, which are designed to protect the homeowner, but you end up with this very delayed distressed inventory coming out. And it tends to be more highly distressed the longer it's delayed too.
Yeah, that's really fascinating. I know watching that, the recovery markets, the markets that had coming out of the bubble, the markets that had judicial foreclosure process, you got to go to court, took years longer to recover than the 90 days sold on the courthouse steps kind of states, and those were the fastest to recover coming out of the biggest mess. Really fascinating to watch. So 1 year between employment shock and the time when it's really starting to be inventory is and
I would say that's a minimum.
A minimum.
Yes.
And so This is really fascinating, right? So, right now we have ultra low unemployment. So even if we start to see unemployment rise by end of the year, it's still probably lowish. Even if the economy is slowing way down and we get some, it's still pretty lowish. So then maybe shock unemployment is mid next year. So then we wouldn't even see inventory until middle of 2024, 2 years from now. If
from something that happened now, I do want to make the point that we are seeing our numbers rise, our volume rise, and it's gradually rise. And we believe the data tells us it's primarily has to do with the backlog from the pandemic. There's not a huge backlog from the pandemic, but there is a backlog of folks who got where the foreclosure process got stopped, and it's slowly restarting. So that so volume is going up because of that, tying back to that event. But to your point, yes, for kind of new volume created out of maybe some of the problems in the economy that we're seeing now, that would be 23, 24 type of numbers that we're talking about.
Yeah, and that'll be really interesting. And then some backlog climbing now. Are you seeing anything? One of the places I'm interested in watching are like the Boise, Salt Lake City, Austin, Texas markets where we had, people moving out of California, buying sight unseen, overbidding. It's okay to spend $1 million in Boise because I just sold for $1.5 million in LA, and and I'm getting more house. So, but that's stopped. And so we can watch markets in places like Boise. The percentage of homes on the market in Boise that have taken a price reduction is like 59% right now. It's really slow. And it took people a very abrupt change. So if I bought in Boise in February and I overbid, and now I'm underwater, and or like I could I assume I'm underwater, and I look like I take a long time to sell. Are you seeing? Are you seeing anything there yet? It seems early before that for those, but do you have any sense on when we might see distressed inventory in a place like Boise, that where people overbid more than any place else in the market? Austin, Texas, Phoenix, a couple of places like that as well. What's the horizon there?
Yeah, I think where we would start to see some of that hit our radar would it's going to be another year or so, really, where we start to see the volume. Now, one of the things we see kind of on another way to look at it with our data is through what the investors are doing on our platform, where they're more aggressive in buying and where they're less aggressive in buying. And they're definitely pulling back more in what I would consider the hottest markets. I could pull this by metro too, but I just by region, just to cast a really wide net. When I looked at one of the demand metrics we look at is the number of times a property that's available for auction is saved. Foreclosure auction is saved. That's a strong
user data on the website.
Yes. Yeah. So how many people are saving that property? That's an indication they're probably going to bid on that property at the auction. And so anyway, that saves per property has been consistently over the last, or this year even, the highest in the Southeast and the West. So the West is the Boise's of the world. The Southeast is maybe like the Atlantas of the world, or somewhere like that. Those have been super hot markets. Those are the properties that are getting the most online saves, but that's also where we've seen the biggest drop in the last few months, just starting in really after peaking in February. In the Southeast, for instance, 44 saves per property up for auction has gone down now to 28 saves. And in the West, 39 saves peaked in February as well, now down to 24 saves, getting close to half of the level. Whereas if you look at the Midwest and Northeast, our investors have stayed pretty steady there. Back in February, both of those were at 25 saves per property, and now they're at 21 saves per property. So it's pretty close. So all that to say, I think our investors are becoming a lot more cautious about those markets there. And in talking to some of those investors who are buying, they're actually saying, yeah, we're shrinking our buy box, becoming more conservative, going to the areas we're more confident in and the price points we're more confident in. And so they are moving away from those super hot markets and those super, what they would call cyclical markets potentially. And so I think that sets those markets up for even more potential downside, in that you have the investors backing off of those markets, which is one channel of demand, along with, of course, the owner occupant.
Yeah. So let me ask you this. So the investors as a backstop for a slowing housing market, a slowing demand housing market, what's your take on how resilient investors are going to be? On the one hand, like they're looking, if I've been buying in Phoenix, I've stopped cold because I don't know what's going to happen next. But on the other hand, rents are pretty good. The rents aren't going down yet. And so as investment properties, like there may be the math still works out just fine in terms of the cash flow. Or maybe it's less because as mortgage rates have come up. So what's your take on investors as a backstop, or maybe not, maybe as a catalyst for further down, cycle?
Yeah, that's really interesting. I think dynamic there going on, but I think see how I want to answer the question in a couple ways, maybe. But I do think when I look at, I look at macro housing data beyond just our data, and I do definitely see some concerning trends with investor activity in some of these markets that I think is speculative and actually mirrors a little bit of the patterns that we saw leading into 2006. Not that I want to compare this to that time exactly. And so I think that's a risk in this market, is in especially local markets like a Phoenix that have been highly propped up or stimulated by investor activity. They're more susceptible to a downturn when those investors are much more fickle source of demand than owner occupants, and when those investors decide to pull out. Now, that said, I would say another way to answer that question is when we poll our buyers, and when I talk to them, and even looking at their behavior, it's not this extreme. They're not so scared of the market as some of the headlines would make it sound. And so, yes, they're becoming more conservative. They are, they're shrinking their buy box. They're bidding more conservatively, but they're still bidding and they're still buying, and they still see opportunity. And yes, there's this kind of element of there's the opportunity now, and there's the potential opportunity if the market did correct or crash, or whatever the word you want to use is. But at least the longer term investors are saying, yeah, this is my business. I'm going to keep buying. I'm going to find the deals. There's always opportunity in real estate. I may have to change the way I'm acquiring, the price I'm acquiring at, but they're continuing, and so they're not the sky is falling situation. But yeah, they're also they're kind of starting to set aside the funds for purchasing in even higher volume if there was a correction.
Right. So it sounds like the investors that you see still have their cash. They still want to participate, and they are participating, but maybe just a more focused buy box. Does that sound about right?
That sounds exactly right. Yeah.
That's really interesting. So, in that sense, it kind of, the fact that they have cash and are waiting for opportunity is really that one. It tells me that arbitrage evaporates very quickly. It's like, when the COVID market, we had our downturn, we had 3 weeks of down market before people started buying.
Right.
And, I know people in San Francisco who've been waiting for 15 years with cash for the next downturn. They're like, oh, we're going to go buy, and they had 3 weeks of opportunity. And so it'll be really interesting to see. Like, that says that because that cash is there and because those people are in that business, it says to me that the investors probably do create some amount of backstop for a downturn to prevent a severe downturn, because they start seeing deals and they're going to buy it. Does that sound like good logic?
Yeah, I think that's good logic for the most part. I mean, I think there's different tiers of investors. There are some of our buyers who, if there is a downturn, are going to get scared and stop buying completely, and but others who are in for the long term who would be more of that backstop. But that doesn't mean that the market they would stop the market from falling. But I think there is a cushion there. There's enough. My sense is there's enough of that kind of dry powder sitting out there that would come into the market. I think there would have to be a correction for that to come into the market, but it would prevent the market from necessarily falling as much as it did last time, just because everybody saw a lot of people made out very well buying during the last downturn, and so there would be a lot of copycats, I think.
Yeah, there's a lot of people look back and we always fight the last war, and so we look back and we want to see the crash coming. People expect to see that a crash must come, and then they also see that I want to be there ready with my cash to buy, and by virtue of having that perspective, they actually prevent the whole thing from happening. That's really
Right.
fascinating. So that,
I think
back to another comment you made in there, which were, you said you see some mirrors to 2006. What are the mirrors that you do see? What feels the same? It's always really easy to say it's different this time, but what feels the same as 2006?
Yeah, two specific data points that I was looking at there are what I'd call short-term flips, which, whatever you want to debate the what that means, but for me it meant homes that were flipped within 6 months or less, as opposed to longer than that, obviously.
Yep.
So there was, if you look at, and this is using data from my own company, Adam, and not just foreclosures, everything, and those numbers went up to a level that was higher than 2005 for the first time at near the end of 2021, looking at it on a quarterly basis. So there was a spike in those really short-term flips, which I would consider potentially a little more speculative. And some of that has, may have to do with some of these iBuyer activity, which would be lumped in with that flipping. But to me, you just look at it on a chart, you see this parallel. And then another one that you look at in a chart and you see that parallel that looks the same, is cash buyers, which is kind of a similar thing. But the number of cash buyers hit an all-time high in 2021. And by a long shot, and I'm don't have the numbers right in front of me, but those cash buyers were just flooding into the market. And that was what we saw in 2005, 2006. The numbers look very similar. That's just higher now than they actually were back then.
So that's interesting. I didn't know that was a characteristic of the 2005 period. More cash buyers at that time. Because is that true?
More cash buyers than that time, but there was that spike in cash buying back then as well. Yeah, that kind of surprised me too, because we blame a lot of the 2005 on just everybody being able to get a loan, right?
Yeah, over mortgaged, right? Everybody was over mortgaged and less equity, but there were more cash buyers at that time too.
Yeah, there was a spike in cash buyers leading up to it. I think that would indicate investors coming in potentially, and probably a different type of investor. Mm-hmm. And I haven't really dug into those numbers as to why, because that doesn't seem to correlate with the storyline of 2005.
Well, I wonder if it's I know a lot of the cash buyers this time were like, hey, I will pay with the cash to get the deal done so I can move to the top of the queue, but then I'm going to refinance. I'm going to finance it out in 60 days or something after I've got the deal closed. And they were simply using cash as a negotiating tactic, even though they were ultimately going to have it financed. But that's interesting. I didn't realize that the cash buyers were doing that in 2005 too. So those are real parallels. And I'm with you on the flips, where, when you're looking at like the deadly move of 2006 was, I'm going to get the teaser rate at 1.1%, and then I'll just, when that thing in a year, when it resets to 6, I won't be able to make the payment, but I'll either refi or I'll sell it at that point. And then all of a sudden you couldn't sell it. And so those flips, I think we at least don't have that part of the market now, right? We don't have people who have mortgages resetting. If they got a loan, they're at, in 2021, they're at 3%, and it's 3% forever. So those, at least, it feels a little healthier on that side to me.
Absolutely. Yeah, I think overall the market is much healthier right now. Actually, I mean, my biggest concern is that the response to the pandemic actually has unintended consequences and ripple effects that lead to another housing bubble. And I don't know if we have a lot of time to get into that, but we've talked about that a little bit. Actually going into the pandemic, we were actually kind of what I would say describe as coming in for a nice soft landing in the housing market, and a much needed soft landing. If you look back in 2019, home price appreciation was slowing down, depending on whose numbers you look at, to single digits, very low single digits. And then we had all this stimulus come into the market and create this frenzy of buying that's created this market that we've seen over the last few years.
Yeah. So let me ask you a couple of more things on the data side. We talked about your saves per property, which is an indicator of investor interest. So if you've got 44 investors looking at properties and saving it, that's a leading indicator of whether they're going to bid on them. And you said that you've seen that number come down, especially in the Southeast and the West, where the big investor markets. And I think it's notable that it's not really coming down in the Northeast or the Rust Belt. So are there other data that you have visibility to at auction.com that is unique to the world?
Yeah, I think another key one, a couple other key ones, but I'll mention the other first one is we look at the winning bid as a percentage of the estimated as is value of the property. Excuse me. So when we get the property, the seller says and this is usually based on an exterior drive-by of the home because you can't get inside. But based on that, here's the value of the property. And then the winning bid is a percentage of that. Yeah, so we've seen that drop. I mean, during the pandemic, mirroring kind of the frenzy in the overall market, we saw that rise. And so people were paying on our platform 90 to 95% of that estimated as is value, which is crazy. Before, the average before the pandemic, just looking at this really quickly, was below 80%, like 78%. So, anyway, during the pandemic, the frenzy, we saw that rise up to 90 and even as high as 95% in some months. But now, since again that topped out in February, it hit 91% in February, and since then it's dropped, and we're now actually at 78% in July, the most recent month.
Oh,
so people are paying less. They're setting their maximum allowable offer at auction lower because they're bidding more conservatively. And I think that's a real sign that the investors are becoming a little more cautious of the market. They're not fleeing the market, but they're becoming more cautious and kind of hedging their bids based on that.
Yeah. So we're at a normal level of value bidding right now. You'd say we're back to a normal level of value bidding. And you can imagine that investors come to a platform like auction.com. Like, part of the point is that I'm getting the asset for less than it's worth. Like, part of the trade is that I'm getting it less than its value. That's why I go work. I go to an auction. And so the discount from that value is back to normal level. Do you have a sense whether that's going to keep falling, or it's going to like? Can you see the slope of the curve? Is it accelerating, or is it? Have we hit a bottom?
Yeah, I'm looking at it. It has definitely not hit a bottom yet. Now that 78%, as I said, is actually happens to be kind of the mean. So if we revert to the mean, I would expect it to bottom out soon at around that number. But it's fallen very quickly from
the
that
90s.
90%. Yeah.
Yeah.
And to be clear, so that's based on the as is value of the home. Of course, a lot of investors are estimating the after repair value, which is much higher. So the discount below the after repair value would be more than that. At 78% actually is getting pretty good, 22% below that as is value, but it's more like 60% below the after repair value. Anyway, just to make that clarification. But yeah, to your point, that they're pulling back, and if it doesn't bottom out, then that's actually a bigger concern for the market, in my view, that the investors are not as confident in the market.
So exactly, like we're here, and then so we really want to know next month, and we want to keep our eye on that to know whether the investors are getting more and more cold feet. There'll be. Do you have a sense on whether that leads some of the other market data, for example, like transaction prices or something like that you can go look? Do you have a sense of, like, is that a leading or a coincident or a lagging indicator?
We've done some research around that, and it looks like a leading indicator. Well, if we combine that metric, the winning bid over the seller value or the as is value with actually the saves number that I mentioned earlier, and run a regression on that, there's a pretty strong correlation by about a month to the median existing home prices that NAR puts out.
Yep.
Home price appreciation. And so it's not leading by a ton, but this July number, if we ran that through that regression, we would be able to predict what NAR's existing home price appreciation is going to be for August. And of course, they don't release their August number until September. So there's a little bit of a lead there, and all of that is pointing to continued decrease in that price, which maybe isn't earth-shattering news, but that price probably going below, or that price appreciation going below double digits very soon.
Yeah,
in the next few months.
That makes a lot of sense to me. Now, okay, so let's shift gears. Let's talk about the future for a second. I am interested, and when I talk to folks on this podcast, I'm interested in their views of the future. In particular, I'm interested in what makes it tank from here. What are the risks that maybe people don't talk about enough, but also, like, where do you actually see it, and where do you think there are risks, or do you think that it's more likely to do another thing? So let's talk a little bit about the future. Where do you see the future next couple of years in the housing market? What risks should we be paying attention to that maybe don't get enough attention?
Yeah, I think the housing market is responding to the efforts of the Fed primarily and slowing down, and I think that's exactly what should happen and needs to happen to prevent another housing bubble. and if we're not already in one. And so I see if that continues and the Fed sticks to its plan in terms of raising interest rates, that should slow down the housing market in a healthy way, and we could potentially achieve that kind of soft landing scenario that we were already on en route for back in 2019, and had this detour here over the last couple of years. That I think is probably still the most likely scenario in my mind, and of course we look at that because it impacts what our volumes are going to look like. And if that were to happen, we would see, this is at a market level, not just our numbers, but we would see foreclosure volume back in 2019. If you look at completed foreclosure auctions, which includes those that are brought to auction and that sell. Anyway, those were 206,000. In that soft landing scenario, we see that returning to, by the way, sorry, I keep on interrupting myself here, but the number in 2021 was only about 63,000. So we're really low.
200 and some thousand completed in 2019 to 63,000 in 20. Like 63,000 is nothing.
It's nothing. No.
Yeah.
And so that the soft landing scenario, we would see that return basically to the 200,000 levels and kind of plateau there. And there is I do think there's a increasing chance here of the recession scenario that a lot of people are talking about in the economy, which would of course impact the housing market, or at least I believe would impact the housing market. And in that scenario where you would see some rising unemployment, you would see home prices, I think, in some markets go negative nationwide, flatten out, maybe go slightly negative nationwide. And in that scenario, we'd see foreclosure volume rise to as high as 450,000 in 2024.
Okay.
So, I mean, I know this is a lot of speculation, but that's somewhere between those two scenarios is how I see the market playing out. And I think to the extent that we don't try, efforts aren't made to cool off the housing market sooner rather than later, the housing market will cool off itself more severely later if it's not done sooner, if that makes sense. So
so that's a real interesting forecast. So let me see if I got it right. Normally we might have 250,000 foreclosure completions in a year. Peak pandemic 2021, we had 63,000, which is like, it makes sense. It's the same ratio of active inventory to, normal to now. Like all of those things seem like they're in that same bucket where like the market was hot for all those reasons and across all those metrics. So normally is 200 or 250. Last year we had 63,000. Like that's nothing. Because you probably,
and that's why we say we have there is a backlog.
Yeah, you probably had those in Vegas alone in 2007. Right?
Oh yeah, no question. Yeah,
and so then in a recessionary world, let's say we go into a sharp recession in 2023, then by 2024 we probably see 450,000 foreclosure completions. Like that's the big recession scenario. Is that right?
Yeah, I would say I would describe it as a mild recession scenario.
Oh, that's the mild. Okay.
Yeah, mild. So that's big, and that has unemployment going up to this is kind of crazy, just about 6%. Nothing crazy. So, and mortgage rates hitting 6% as well. So yeah, I would still describe that as a mild recession scenario.
Yeah, for sure. Okay. So, but that would put at risk a bunch of those buyers, FHA buyers, especially buyers that bought in early this year in the hot markets. There'd be a few of those folks that'd be that'd be at most risk, and then you lose your job and like things stumble, then those are when those start happening. So what happens?
You do have the twin issues of loss of job, and that scenario also has slight downturn in pricing in home prices, and so you had that combination can be really lethal for some homeowners.
For sure. And and I could watch it. We could correlate it, the default rate to we use our market action index, which is a supply versus demand, but you could also do it versus the time on market. So if I'm looking at the median days on market at 200 days in my neighborhood and I lose my job, I'm never going to sell this house. But, in 2021, if I lose my job and I'm in a weird situation, the median market time is 7 days. Like, I'll go sell a house, and that's, therefore, like I'll put it on and it'll be done before I even miss a mortgage payment. Like the whole thing, like it's really incredible that way. When the market time was 7. So therefore we ended up with only 63,000 foreclosures that year. So, watching market time climb at the same time as we hit, we flatline. And I think we're going to flatline on home prices based on the fact that we are, that inventory is climbing year over year pretty significantly. So it's still lower than normal, but I think we're going to see flatlined on home price gain over the next year. And recession. So all of those things hit. Do you have a quick take on what happens in a severe recession?
Yeah, we haven't modeled that specifically, but I think that's that 450,000 can quickly go up. I mean, the problem, it becomes, I think, somewhat, it's always there's a psychological element to this too, but it becomes in that scenario, there's an exponential effect on some of these things with the psychological impact. So I don't have a number to spit out, but I think that number can quickly become quite higher. By the way, to put it in context, at the peak of the last crisis in 2009, we saw just over 1 million foreclosures. So even the 450,000 is less than half of that peak.
Yeah.
But a more severe recession. And I think that becomes, your initial question here, which I may not have really answered, is what's the risk that nobody is thinking about? And I think there's probably plenty of people thinking about this, but the risk I think about is if we continue to try to keep saving the housing market, that actually puts us at risk for the housing market at some point, being a house of cards that collapses because it's just being saved over and over again, if that makes sense. And so to the extent we try to keep stimulating or saving the housing market, we get at more risk for that more severe recessionary, at least in the housing market scenario.
Yeah, the forest naturally has to burn a little bit each year. And if it doesn't burn a little bit each year, one year it burns really big.
Yeah, that's great analogy. Coming from Northern California,
that's right,
person, and
I who can't get insurance on his house.
Oh my goodness, yeah.
Daren, this is really terrific. We've covered a bunch of things. Where you do a lot of posting on LinkedIn. A lot of people follow you on LinkedIn. A lot of great data there. Is that a good place for people to follow and track along with your output?
Yes. Yeah. I'm that would be the best place, I think, to follow it. On auction.com, where we post a lot of my stuff, is auction.com/in the news.
Okay.
And just all one word, in the news.
Yep.
And post post a lot of great stuff there. One of the favorite things that I've been doing lately is going out and interviewing some of our buyers on location, and we have some videos there, so that's really cool. But yeah, those are probably the two best places. I try to be a Twitter guy once in a while, but I'm not really a Twitter. I'm not cut out for Twitter, so that may not be the best place to consistently see my stuff.
Great. Well, I'm going to go watch some of the videos, the interview with some of the buyers. Love to see those. Now August. Are they changing? Are their takes changing? Interviewing a buyer in Boise or Phoenix right now or something like that to see what their take is.
Yeah. That actually we don't do as much timely stuff with the buyers. It's more about their story of what they're doing in their community. So
okay,
I just don't want to set you up for
I get it.
set your expectations
totally
up. But that would be really cool to do more of that. Is just the quick takes on what's going on in your market right now.
Yeah, and I suppose when you do that, you get their story, you understand about whether they're in this for the long haul, and it goes back to our conversation about are they the backstop or are they the catalyst for a faster tanking market?
Yeah. And I would answer there. I would say the buyers we have right now are more of the backstop. There are certainly more of the buyers who are just jumping into the market because it's a hot market. But a lot of them are the folks who are just buying in a certain community, and they've been doing it for 20 plus years. And they're also not the big institutional investors. A lot of people think those are the folks buying at foreclosure auction. There might be a little bit of that going on that we see, but most of the people in our data are buying less than 10 properties a year from us. So anyway,
yeah,
I see. I'm confident in our buyers, but as providing at least one form of backstop in their local markets.
That's terrific. The vast majority of real estate investors in this country are individuals with a handful of properties. Like 90% of all that, and even though the big hedge funds get a lot of press, it's like this is like people getting one or two properties and holding on to one or two, and or maybe building a small portfolio of few a year, that's who owns the properties in the U.S. Okay, Daren, terrific. Really appreciate your time and your insight. That's exactly what we like to do with the Top of Mind podcast. Everybody, this has been the Top of Mind podcast. I'm Mike Simonson, and we've been talking a lot about the data. If you need to get the data for your local markets, go to altosresearch.com because buyers and sellers right now absolutely need to know what's going on. And a lot of the dynamics that Daren and I have been talking about are reflected in the data so that you can communicate these trends to those buyers and sellers right now, to investors right now. What do they need to know, especially if they're out of market investors buying into your town? Lots of real opportunity out there, and everybody needs to know. So that's why we have Altos Research. So everybody, Top of Mind podcast. I'm Mike. Thanks. More next week.
Thanks for listening to Top of Mind. See you again next time, and be sure to click subscribe to get future episodes.